And we are live. Thank you, everyone, for joining the inaugural session of the Toggl Academy, an initiative we're really excited to kick off. And not the least because of the guest that we have today. It's Marcel Petitpas from Puerto Quito. And I'm really excited to hear Marcel's thinking on a topic of how to run a profitable agency, especially in 2023. I think we all know what kind of situation we're finding ourselves in, so I'm not gonna repeat any of that. But I think some of the things we're gonna hear and learn from Marcel would be applicable in any kind of situation. So regardless whether we have blue skies, economically speaking, or some rain this year, I think it's going to be just super useful and super exciting to anyone who joins. Marcel, thank you very much for joining us, for doing this with us. And with that in mind, I just want to give you the floor and let you share your thinking on the topic.
Thanks so much, Ilia. And thank you, Toggl and the whole team for having me. It's really a privilege and an honor to be the first guest, I suppose, to be a part of the Toggl Academy. And I'm really excited to see Toggl leaning into, providing more educational resources to the community at large. So really great to be here. As you mentioned, Ilia, I'm Marcel. I run a company called Parakeeto for all of you that aren't aware. And this is what I do all day, every day. I help agencies and professional services businesses make more profit and be more sustainable. We do that through Parakeeto, where we do consulting engagements that are focused on helping you measure and improve your profitability. I'm also the host of the Agency Profit Podcast, where you'll never guess what we talk about. So if you enjoy the presentation today, be sure to go subscribe there for more free content around this topic. I'm also the head strategic coach at SaaS Academy, where I apply the same kind of knowledge and thinking to software companies. And I get the privilege to do this at Goldfront as well as a fractional COO, where I get to be a little more in the weeds than I otherwise would be with our clients. And, I've already talked about this, but this is all we do. It's all we care about. We're not an accounting firm that also focuses on profitability. We're not a software company that also focuses on profitability. Our core business is designed completely around helping agencies run a more profitable business. And we have a bit of a unique perspective on how to do that. And I get to do a lot of this. I like to talk. I like to hear myself talk. And so today is a good day because I get to do both of those things. And I've had the privilege of being on many great stages. And this is another one to add to the roster. I might have to add the Toggl logo to this slide after today's presentation. So here's the problem that you might be experiencing. And if you're feeling any of these things, then know that you're in the right place. Number one, you might not have a clear strategy or vision on how to navigate the next 12 months. If you're worried that there's going to be an economic downturn, which is probably a pretty reasonable speculation, and you might generally not have a clear strategy and vision as it relates to using data to make decisions in your business, to ensure that you have the right cash flow, to ensure that you have the right profitability, and to really be making decisions from a place of objective reality and not necessarily from guessing things out. And part of the reason why this might be hard is because you've got messy processes and tools. If you've ever tried to answer a question with data and found yourself in a spreadsheet for hours cleaning up data, or realizing that you haven't even tracked the thing that you needed to track in order to run a report on that, then you're not alone, is what most of our clients are dealing with when they come and see us. But it can really hamstring your ability to use data to answer questions, even when you want to do it, because the data is just not ready to offer you those insights. And what that might leave you doing is guessing and stressing about really important decisions in the business. Do we discount this project to get this client? Do we hire this person? Do we fire this person? And all of the important decisions that you make that have to do with clients, projects, people, and their livelihoods, and really big important investments that you're making in your business. So if any of this is resonating, I'd love for you to leave a comment on LinkedIn, because I can see those show up here. I'd love to hear from you if any of these are resonating, and if so, which one resonates most with you? And so if you're experiencing these problems, you're in the right place, because here's what we're going to talk about today. Number one, I'm going to talk about some very clear metrics and benchmarks that you can use, not only during an economic downturn, but as Ilia mentioned, any time that you're running your business. I want to talk about strategies that are evergreen, that allow you to capitalize when times are good and when times are bad, and ultimately be a sustainable business and make thoughtful decisions at all times. I want to give you a framework for decision making so that you understand 3 simple numbers that you can pay attention to and use to move your business back to a healthy place no matter what happens in the market, and ideally use those to create alignment among your team and predictability so you can look out into the future and get an understanding of what's going to happen and make decisions with that in mind. So with that, if you're ready to rock and roll, if you'd like to hear more about this, leave me a comment on LinkedIn. Let me know that you're ready to rock and roll. Otherwise, I can just jump back to what I was doing before, which was enjoying my morning coffee and checking emails. And we don't have to do this, like all of you can go back to whatever you were doing. But Alexandro says, messy process for sure. Thanks for the insights you're giving us. I appreciate it, Alexandro. It's nice to hear from you. So I know that there's at least one person listening. And for that reason, I'm going to keep going. Hopefully the whole team at Toggl wasn't scared there for a moment that I was actually going to bail out. Hey, Katie, nice to see you. Thanks for joining us today. All right. So I don't want to spend a lot of time on the very generic principles that you'll hear from anyone that's talking about how to handle an economic downturn, especially finance people. There's some really obvious stuff. I want to spend more of our time focused on things that are a little bit less obvious, but the basic principle when you're going into an economic downturn is have cash, right? I could drop the mic and walk away now. That would be about as useful as one of those webinars that's about how to just raise your prices and all your problems will go away. It's a little reductionist, right? So easier said than done. Have a lot of cash. If you don't have cash, things are going to suck more. You're probably going to have to do some cost cutting pretty aggressively. You're probably going to have to lay off team members on very short notice, and you'll probably have to give them pretty bad layoff terms because you're cash constrained. And you'll probably have to take on expensive debt and start playing, vendor payment delays. And debt is very expensive right now. It tends to get more expensive in a downturn. So more cash is always better. That's especially true in a downturn. And we're really transitioning from a period over the last 2 years where putting your cash to work was a pretty good idea. Leveraging your cash was a pretty good idea because debt was cheap. Interest rates were high, return rates were high. The market was very frothy. It was a time to kind of push the chips back into the table. When the market shifts and the interest rate skyrockets like it has, we want to start conserving that cash, because if we have it, then this can actually be a really big opportunity for us. We can retain customers more effectively by either, and we'll talk about discounting and how to know what's appropriate, but we can start to become flexible with payment terms, which is often a really good way to avoid discounting a project, but still making concessions for the client. If we have a strong cash position, we can use that as a negotiation lever to retain clients that might be thinking about cutting us. We can be more thoughtful about cost cutting and layoffs. And when we do layoffs, we can do it in a more equitable way because we're not constrained by cash. We can give people fairer compensation and layoff packages. We might even be able to give people smooth transitions, move them into freelance roles, etc. And a lot of times, and this has been true in every economic downturn, when the market is struggling, people who are struggling the most are going to have, distressed businesses, distressed assets. There's going to be clients that are going to be dropping off and looking for a new place to put their marketing budget. There's going to be a lot of staff turnover. There's going to be a frothy freelancer market. So having cash gives you the ability to actually take advantage of a lot of these things. You can negotiate better rates with your vendors. You can often deploy that capital to get a really good deal on some of the services and vendors that you're going to be using. And you can put yourself in a position to actually take advantage of the fire sale that tends to happen on a lot of distressed assets during this time. So that's the stuff that you're going to hear from everyone that's talking about this. It's obvious. It's kind of like the very typical advice. So I want to talk about the things that happen underneath this that allow you to determine your cash position and take more control of it. Because having more cash is a really easy thing to say. It's a very hard thing to do, especially in a business like services. So some common mistakes that people make in this time period, and we'll start to address these, is number one, having a lack of forward visibility on cash flow and capacity. So you want to be able to put yourself in a position to understand what's coming up so you can staff yourself appropriately and make sure that you're not going to burn too much cash. So the first level of this, of course, is just a cash flow report. And you can do those yourself in a spreadsheet. You can use simple tools like Cashflow Frog or Float. And you can have your bookkeeping or accounting team do this. It's not a hard thing to do, but it's critically important to start staying on top of this, especially as the economy starts to turn. But also very, very important, we'll talk about this, is your capacity as a team and making sure that you have enough hours available relative to the hours that you're going to need to service clients, and vice versa, that you have enough hours to service clients and that are going to be sold to clients relative to the capacity that you have on your team. Another really big mistake that people make at this time is they have a lack of clarity on their margins and their discounting flexibility. And they start to get really, really focused on retaining revenue. And a lot of times it can actually make their business worse and not better, because they're basically compounding indigestion. So worsening indigestion by taking on revenue that's not profitable, or revenue that's very, very unprofitable, or having no clarity on the boundaries that they have when it comes to negotiating with clients. So if you're going to start using discounts, you're going to start using lowering rates in order to retain clients, or maybe pick up clients that are coming over from other agencies that have recently left, you want to make sure you understand exactly what the boundaries are around this. And we'll talk about how to determine that. Another one is discounting over payment term negotiation. So when somebody pushes back on price or is asking for a discount, the first response to that should be, let's talk about payment terms first, because often that's a lever that can get moved without actually changing the price and still achieves the outcome that the client is looking for, which is ultimately protecting their cash flow. Another one is waiting too long to make hard choices. Often this is because we didn't realize we had to make this choice until after it was already time to make it. And this especially has to do with cost-cutting measures and layoffs specifically. If you're already behind the 8 ball when you're making layoffs, it's probably too late. So we're going to talk about how to predict when that might happen, and then how to set some very clear boundaries around that. And then finally, doing multiple rounds of layoffs, right? I've seen companies do this. It's really, really rough when you do a round of layoffs and then a week or two later you do another round of layoffs, and maybe a week or two later you have to do another. It's always best to try and get that over with at once, and it's better to just cut deep and fast once than it is to basically destroy your company's morale several rounds of cuts at a time. And again, the reason a lot of people do this is because they're not equipped with the right data to have the foresight to figure this out. So here's what we're going to talk about briefly here today. We're going to talk very quickly about core financials that we want to pay attention to, just the economic truths about a service business, some simple numbers that you'll be able to hopefully walk away with today and immediately get some value from, because you can talk to whoever's running your finances and say, I need to see this on my P&L, and you'll get an understanding of where you stand, and you'll have the ability to look at this into the future. Then we'll talk about margin levers. And these are going to be the numbers that you can use to get much quicker visibility into what's happening in your business and easily forecast into the future. And we won't spend a lot of time today on scoping accuracy. We'll briefly touch on this, really just to clarify how to figure out what your pricing sensitivity is in a downturn. But unfortunately, we won't have time to go all the way through scoping accuracy today. So with that, if you're ready to jump in, we're going to start with core financials. And I want to start with, what are the numbers that you absolutely should be seeing on your profit and loss statement? And if you're not seeing these, you want to go talk to your accountant immediately and get these answers. And so the first is revenue, which you might also be calling income. That one's pretty obvious. If you're not seeing that on your financial statements, then you've got bigger problems and you need to go deal with those right away. But then the second one that you want to be able to measure is your agency gross income, AGI, which stands for agency gross income. And so what's the difference between revenue and AGI? Well, the difference is what we call pass-through expenses. And pass-through expenses are essentially the money that comes into your agency that doesn't actually belong to you. It's passing through other vendors. And examples of that would be things like if you're doing advertising on behalf of your clients and they're giving you that money, but you're then spending it on the ads, that would be passed through. So all the money that goes to Google, Facebook, LinkedIn, whatever the platforms are that you're advertising on, that would be an example of pass-through expenses. Things like website templates, stock photos, white label partners that you might be bringing in on a project. Those are all examples of pass-through revenue or pass-through expenses, I should say, and you might be applying markup to those. That's fine. Those will be retained in your agency gross income. But what we want to do is strip out all the expenses that pass through you onto other vendors so that we can understand how much of this revenue do we actually need to earn with our operations. The next thing you want to be able to see is your delivery profit. And your delivery profit is going to be your AGI minus your delivery costs. And what are delivery costs? Well, this is really the gross margin of your business. It's how much does it cost you to get work done for your clients? And generally, this is going to be the payroll and some of the tools that are used to get work done for clients. So if you have a team of designers, project managers, developers, strategists, copywriters, creative directors, those are all people whose payroll is most likely completely or almost completely allocated to delivery. And so the delta between your AGI and your delivery profit is going to be subtracting out your delivery costs. And that will give you a sense of what kind of gross margin are we running at as a company. And generally what we want that margin to be is above 50%. Sorry, above is the other way, right? This way, above 50%. If we can be above 50% on the profit and loss statement, we're in a very good position to actually have a strong bottom line. And the reason for that is because the last thing we want to be able to isolate on our profit and loss statement is our overhead. And this is really the cost of running the business. Is going to be stuff like sales and marketing expenses, administrative expenses like accounting, lawyers, etc. Facilities expenses if you happen to have a physical office, or if you're a virtual team, maybe you're providing office equipment for your team, laptops, desks, things of that nature. And you want your overhead generally to be between 20 and 30% of your AGI. And generally, this is broken down into sales and marketing at 8 to 12%, admin, these are just very rough ranges, 8 to 12%, and facilities at 4 to 6%. And again, if you run a virtual team, you might have very little facilities, which means maybe you're spending more on sales and marketing, more on admin, whatever the case might be. And ultimately, what that should leave you with is a profit margin of 20 to 30% on the bottom line. This is what we want to plan for. And then what happens is if we have some unexpected downturns, we have unexpected investments that we make in the business, etc., we've got a buffer here that still allows us to get to something that's reasonable, like a 10 or 15% profit margin. But if everything goes well, we end up being really healthy, 20 to 30%. So this is our profit that's left over. Is this tracking with everyone so far? Let me know in the comments below if this is making sense. So the thing that, of course, we want to focus on today is, I could talk about cutting overhead expenses. This is really obvious, right? You're going to go through your P&L, you're going to cut software and try to save money on these places. And this is where a lot of people tend to focus their energy when they're thinking about improving their profitability. But in our experience, auditing dozens of agencies, working with them to improve their profitability, what I can tell you is that more than 9 out of 10 times, the problem is that an agency does not have enough delivery profit. So either their agency gross income is too low relative to the cost of their team, or the cost of their team is too high relative to their agency gross income. So what I want to focus on today is how to really understand and measure this and how to influence it, how to make it better. Because when delivery profit is strong, and when we maintain our delivery profit throughout economic changes, that is what generates the bedrock for a healthy business and really puts a lot more of the control in our hands. We can choose to over or under invest in overhead. We can choose to deploy capital in a way that's appropriate for us and still have strong cash flow and strong profit. All right, so let's dig into this. I won't go through this example. It's fairly straightforward. There's 3 levers here that determine our delivery margin. So as a reminder, okay, the delivery margin formula is the following: agency gross income minus delivery cost divided by agency gross income. So as an example, if I had $1 million in revenue and I spent $400K on delivery costs, that would be payroll and maybe a little bit of software, divided by 1 million, I would have a 60% delivery margin, which is great. So there are basically 3 ways to influence this number. And the first way is to decrease our delivery costs while keeping our agency gross income the same or higher than it was. And that really comes down to our average cost per hour. And the reason we use average cost per hour is because this then becomes a metric that can scale both vertically and horizontally in the business. What I mean by that is we can measure our average cost per hour very inexpensively and quickly for the whole business, or we can just look at a department. We can look at a specific client. We can look at a specific project. We might even be able to, if our data is structured properly, if we're really, getting the most out of our Toggl deployment, for example, and we're tracking time very diligently, we might even be able to know what the average cost per hour was on a specific task or a milestone or a phase within a project. So this can scale very, very well vertically within the business. And then it also scales very well horizontally. We could look at this for a week, a month, a quarter, a year, really any time period for which we have reliable time tracking data. So average cost per hour is going to determine essentially the cost basis. So the obvious thing here is lower your average cost per hour, and then your agency gross income doesn't have to be as high. It could be more forgiving. That's a very simple, but definitely not easy thing to do. Generally, this takes place over a longer time horizon and has to do with things like documenting better processes, making those processes more efficient so that less senior people are required to do that work. There's less judgment required, which generally means less experience, which generally means less cost. You might also be evaluating, especially if you run a remote team, more of a geo arbitrage strategy where you are, going to look at different parts of the world where you can get talent that is, less expensive. So there's lots of different strategies you can use here to lower average cost per hour. And again, simple, but not easy. It looks, Christy, like you're having some trouble with this. As far as I know, there will be playback, but I'll defer to the team at Toggl here to let you know for
yes,
sure.
For sure, this is being recorded, and we'll share it with everyone who left us their contact, so you can rewatch it. Thanks for asking, Christian.
Thanks, Ilia. All right, so average cost per hour, just so everybody understands exactly how this is calculated, is a very simple formula. Essentially, all you do to figure out somebody's average cost per hour is you take their total compensation and you divide it by the number of hours that they work in a given year. And for most people, this is going to be, we want to look at this in a gross number. So this is going to be, let's say they get paid $100,000 and then there's another $20,000 or so in benefits. That's 120K. And for most people, they're working 2,080 hours per year. So 40 hours a week times 52 weeks a year. So 2,080. And in an example like this person's average cost per hour would be $120,000 divided by 2,080. And I know there's project managers watching right now who are thinking, but Marcel, what about all their vacation time and their paid time off? And not all that time is going to be billable. I am viscerally aware of that. And I love how detail oriented you are. That's why you're such a great project manager. And I love you. But there is a time and a place to introduce that complexity, and that time and place is not right now. So hopefully I've appeased some of your anxiety and I'll explain essentially where we factor this in, but we want to do it later. If we do it this early with average cost per hour, then we have to drag that complexity around through the whole reporting system. So we want to keep this simple for now, and we want to factor that in when we talk about setting our margin targets on projects. So this is how you would calculate average cost per hour and start to get a sense of what it is for the business and maybe how it varies from one service to another, from one client to another, from one department to another, etc. So simple example of this, we have this strategist that's 120K a year. They have an average cost per hour of $57.69. If we wanted to target a 70% margin on a project, our average billable rate in this case would have to be $192. Conversely, we have an intern that costs less than half of that, $55K a year. So their average cost per hour is $26.44. The average billable rate for them only needs to be $88 an hour in order for us to hit our 70% margin. And if we blend those two together, we end up at an average of $42 per hour in cost and a required average billable rate of $140.20. And so you can see here that if I can take a strategist that's doing 100% of the work on a deliverable, and I can get an intern to do half of that work by, again, creating great process, creating, better systems, empowering them with better tools, I can drop the cost per hour pretty substantially here, and therefore make the amount of AGI required more forgiving. So that's the first lever. But what I'm often more interested in, and what clients are often more interested in, is the other side of this equation. How do we get the same team to produce more revenue without changing the number of hours that they work, without changing, the composition of the team or how much they get paid? And so I want to talk about the two levers that you can use to do that. And the first is average billable rate, ABR. It's one of my favorite metrics. And I love this metric because it can give us so much information so easily and quickly and inexpensively. The formula for average billable rate is essentially agency gross income divided by hours. And you can think about this in terms of, let's say, for example, we have a project where we charged $15K, and it took us 200 hours to do this project. So as you can imagine, the average billable rate on this project is not going to be very good, $75 per hour. So it doesn't matter if when we gave a quote to the client, we said we were going to charge 150 or 200. What we actually made on this project was $75 per hour. So what this metric allows us to do is get an understanding of how much money do we earn for every hour that we work for any subsection of the business over any period of time. So just like average cost per hour, this scales vertically, it scales horizontally to the extent that we have structured time tracking data. So if we can understand our AGI and the number of hours for a specific client, a specific milestone within a project, a specific service line, we can measure and compare ABRs across those things and start to get an understanding of where we make more or less money per hour, and therefore where our earning efficiency is better. And again, we can look at this for a week, a month, a quarter, a year, for the whole agency down to, the most precise level if we want. So let's talk about an example of this. You might run a report that shows you average billable rate by project. And this is the kind of thing we see all the time when clients start running these types of things. We ask them like, hey, what are your most profitable projects? And they might say, well, it's the website build, because that's the highest revenue number. But if we look at the website build here, sure, it was a $70,000 project, but we had $20,000 in pass-through costs. So really it was only a $50,000 project for this client. And we had 500 hours required to get this done. So the average billable rate was only $100. Actually wasn't very good. Then we had a brand design project, which was smaller, $20,000. We still had some pass-through on that. So it was really only $15K in AGI. And it took us 100 hours to get that done. So that was actually better. It was $150 per hour. And then we had the funnel build, the dark horse. That doesn't look that good. It's $30,000, but we outsource a lot of it. So it was really only 10K, but it didn't take us much time to do this. It took us 50 hours to manage the revenue. So we actually made $200 per hour. So this kind of report can be really enlightening and can start to give you a sense of, like, if you have to start cutting your team and you need to cut some clients or replace some clients, or you're trying to figure out what clients you're going to fight to retain and which ones you're not, this can really help you get some clarity on what to sell more of, what to sell less of, and how to start replacing clients or how to start choosing the clients that you fight for or not. It could be very, very insightful. And we'll talk a little bit about the math behind this and just how impactful this number can be. And again, when we blend these things together, we end up with an average of 115. But you can see here that there's quite a spread. Different service offerings are servicing as having very different levels of efficiency. So average billable rate is the second metric. And what's cool about this is we can use average billable rate and average cost per hour as a proxy for delivery margin. So if we're still waiting to get our profit and loss statement from our accountant, because it's, a week after the month is over, we want to get a sense of how are we doing, and we want to set a target for average billable rate, we can do it using average cost per hour and average billable rate. So let's say, for example, our ABR is $150 per hour, and we have an average cost per hour of $60. We pay our team very well, which is great. Then we can start to understand that in this particular example, I got to make a rule for myself that I'm not allowed to do math live on webinars. It's always very risky. So our margin here is about 60%, right? So we can start to get a sense, a directional sense of, roughly what kind of margin are we doing both when we're estimating projects, but also when we're watching projects go through their life cycle and get an understanding of margin using these two numbers as a proxy. And what I love about this is it does not rely on financial data, which tends to be very precise and accurate, but very slow, not very timely. And it can be very, very precise without a whole lot of cost. All you need is two inputs in order to measure this for any section of the business. So hopefully that's making sense. So we've talked about average cost per hour. We've talked about average billable rate, but there's one more important lever here that determines agency gross income. And in an economic downturn, this is probably the most important one, and it's utilization. Okay, utilization. How many of you have heard of the term utilization? Let me know in the chat or in the comments if you have. If you've ever heard the word utilization, this is the most misunderstood metric in the agency world, in my experience. And I like to call it, I'm a bit of a Star Wars nerd, so it's like the dark horse of agency metrics, not the dark horse, the dark saber. It has great power, but can also cause great destruction. It needs to be used very, very carefully. So the formula for utilization is very simple. And that is part of the problem, is that this metric seems so simple that we tend to overcomplicate it. And essentially what this is it's the number of delivery hours worked in a given period of time divided by capacity. And delivery hours might be the same as billable hours for you, but we'll talk about why we use that language at Parakeeto to describe the hours. Because, well, essentially, I'll explain it to you now. There is sometimes a difference between a billable hour and the amount of hours that were worked on a project. If you have time and materials projects, for example, you might have billed the client for 100 hours, but worked 120 to get the project done. So the delivery hours would be representative of the 120 hours that were actually required, even though those are different technically than the number of billable hours. So sometimes those are the same thing in an agency, sometimes they're not. We want to just make it clear that what we want to look at is all the time that's required to get a project done for a client, regardless of if they're technically billed for that time or not. So to give you an example of this, if I had 100 delivery hours divided by 200 hours of capacity, I would have a utilization of 50%. So the other side of this that often gets conflated is, what is capacity? And again, going back to the formula for average cost per hour, at this level, what we want to do is leave all of the capacity in here. So that includes all non-billable staff. It includes all paid time off, everything in this number. So the capacity of a full-time employee is generally about 2,080 hours per year. We don't want to remove vacation time, paid time off, non-billable anything from capacity for the purpose of measuring utilization, pure utilization. And the reason for that is very, very simple. For this metric to be useful as an indicator of financial efficiency, we can't remove that stuff, because if we did, then all of a sudden the metric starts to tell us the wrong story. Simple example. If I'm adjusting vacation time out of my capacity, which means that when somebody takes vacation time, I remove that from their capacity. What that means is the more vacation time somebody takes, the more profitable my business becomes. Well, we know that that's not true. The opposite is true. And so the metric can't be adjusted to tell that story because it's not an accurate story. The efficacy of this metric is no longer what it needs to be. There is different versions of utilization that are often measured. Delivery utilization, for example, would be one where we are subtracting out all of those things from capacity. And really, that's a project management metric. And it's meant to ask ourselves, are we doing a good job of utilizing the available time? But it's different than a financial efficiency based metric of utilization, which really pays attention to how much of the time that we buy in bulk from all of our employees is being used to earn money for the business by getting project clients done. So it's an incredibly important metric and is one that really needs to be closely monitored during an economic downturn. And again, if we remind ourselves of the formula, it's delivery hours over capacity. So in this situation where we have a certain amount of capacity, we have a certain amount of delivery hours, and then we have our target, and we are clearly going to be under our target, right? We look out into next month and we go, yeah, we've got more capacity than we have delivery hours. What are the two levers that can be pulled in this instance to hit our delivery target? Let me know in the comments what these two levers are. Yeah, and it looks like Michael, yeah, you're calling this metric yield. That's cool. I've seen, lots of different terminology for this, and you got your own language. I think that's great. As long as everybody agrees on exactly how it should be measured, that's the important thing. Appreciate you sharing that. So what are the two levers that you can pull in this case to improve your utilization? Let me know in the comments. The first one is the one that we want to generally look to first, which is we want to increase delivery hours. Increase delivery hours. So sell more work, right? Of course, that's the first one that we want to look to. Here's the important thing though, is just getting your team to work more hours does not improve your profitability. Getting your team to earn more revenue does. So I see this often where an agency owner will see that their utilization is low, and then they'll go tell their team, hey, our utilization is low. We need you to hit this target. And then their team just starts spending more time doing the same amount of work that they did before, or they just start lying on their timesheets. Neither one of those things are going to improve your profitability. Because if you remember the formula for average billable rate, if I just start spending more time to get the same thing done, it's just going to lower my average billable rate. It's a sideways movement. It's horizontal at best. In fact, it's worse than horizontal because now your clients are starting to get used to a level of service that's not reflective of the price that they're paying. So I would rather not do that. I would rather have the team have a low utilization and be clear about that than to just ask them to spend more time that doesn't actually earn the business more revenue. Now, in the event that we can't sell more work to then capitalize on this available capacity, the other option is to decrease capacity, which is just a very corporate way to say we have to lay people off, which is the worst, probably the worst thing that you'll ever have to do as an entrepreneur. It sucks. Nobody wants to do it, but this is generally one of the things that happens during an economic downturn, especially if we don't have a lot of cash. We have to make this decision. And so we've got to lay people off. And if we're forecasting our utilization, that's how we can get really, really thoughtful about exactly when and who and how to do this. And a lot of times what we might have the option to do here is to convert some of our capacity into elastic capacity, which is a fancy way to say freelancers and contractors, where they are only ever brought in to work on things when there's billable work to do, and we're not paying for their capacity when we don't have work to do. So maintaining elasticity when there's a little bit of turbulence in the market or in a specific area of the business can be a really, really good way to handle this. So we have a great question from Derek, which I'm about to answer, which is what are the benchmarks for this? So we'll talk about that in a moment. In this example, this would be a utilization report that you might run, where you could see here that for a month, Brett had 160 hours of capacity. He worked 100 delivery hours. He was 62% utilized. We have a part-time employee down here that had 80 hours of capacity, worked 50 delivery hours, was also 62% utilized. And this whole team in aggregate was 67.5% utilized. So what are the targets? Well, this is going to run the gamut. What's really important here is that as an agency, generally speaking, if you want to charge this, reasonable rates that are in line with the market, you generally want to be able to achieve a 50% or higher net annual utilization across the entire team. So that means looking at everybody on the team, including non-billable staff, including managers, including all the billable staff. In aggregate, after all the vacation time, all the holidays, et cetera, the amount of billable hours or delivery hours worked relative to the total capacity should be over 50% of the time that's been purchased, generally speaking. Now, we'll talk in a moment about why this doesn't have to be true. If you want to have a lower utilization in this by design, that's fine. You just have to charge more money than everybody else. And that is something that, if you are in a position to do it, I encourage you to explore that option. But know that that's the case. Somebody has to pay for the lower utilization, and ideally it's going to be your clients and not you as the owner. So this is really the requirement, and you can get here in a lot of ways. Generally, the way that we see this is on a weekly basis. Pure producers tend to be at 75% plus. So a pure producer would be somebody like a designer, maybe a copywriter, a strategist, a developer, somebody whose full-time job is focused on getting work done for clients. Generally, we would expect them on a weekly basis to be at 75% plus. So this is about 28 out of 40 hours or more. We've seen this go up as high as 90%, but generally that's in agencies where that producer gets to work on one client for very extended periods of time, and it is not bogged down typically by a lot of internal meetings or process. Delivery managers, this would be someone like maybe a design director or somebody who is overseeing a team. 35% plus is kind of a good place. Project managers, account managers typically are falling into this range as well. These can be very high as well, but there's a lot of splay here because of how much variability there is in the scope of their job as it relates to managing the team versus doing client work. And as an agency on a weekly basis, you want your team to be capable of hitting a 65% plus utilization rate. And then on an annual basis, you're generally going to lose between 10 and 20% of that. So pure producers should be at 60% plus, delivery managers is 20% plus. And again, as an agency, you want to ideally be able to land at 50% or higher. So Derek, I hope that helps answer your question about targets, but let's talk about how these things come together, because there is an infinite combination of ABR and utilization that can get you to your profitability goals. And to illustrate the example of just how impactful this can be, I want to run through a scenario here. So let's imagine that we have 10,000 hours of capacity on our team. This is roughly 5 full-time employees. In the first scenario, we have a 50% utilization rate over the course of that time period. And we have an average billable rate of $100 per hour. That means that this team will earn $500,000 in agency gross income. In the second scenario, we have the same team, but our utilization goes up to 60%. We keep our average billable rate the same. This agency can now earn $600,000 with the same team. We assume in this scenario that it's the same team, the same cost, the same overhead. Nothing has changed, but the profitability of the business has just gone up by $100,000, which relative to 500 is a very big percentage. That's a substantial increase in profitability. And then in the last scenario, we're going to keep our utilization at 60%. And increase our average billable rate to $125 per hour. And in this case, the same business can earn $750,000. So these simple numbers, they're small. They don't seem that meaningful in terms of improvement, but you can see that even in a really small agency, 5 employees, the impact here is substantial, right? We're talking about a 50% increase in profitability for this business. That's massive. And this could be the difference. That $250K could be the difference between being in the red and being in the green. So paying attention to these numbers and starting to pay attention to which departments, which teams have higher, lower utilization, and then which clients and projects have higher or lower average billable rates can be very, very, very powerful for decision making as it relates to staffing, where to have elasticity in the business, what kind of clients and projects to focus on, where you're capable of being more flexible on payment and terms, etc. So this hopefully illustrates how also you can start to pull these levers. If you want to design the business to have a 40% utilization, you want to give everybody Fridays off, that's no problem. You're just going to need to increase your average billable rate to cover that. And as long as you can achieve it, then that's your prerogative. So finally, I want to just kind of recap and then we can go into Q&A. We've talked about core financials, and the key here is making sure that on the profit and loss statement, you are above 50%, which means that on a project by project basis, when you set your price and you quote that price, you want to add 15 to 20% to this. So we generally recommend being above a 60% margin. This would be agency. This would be on a project basis. And the reason for this is when we talked about that delta between the average cost per hour and when we strip out vacation time, non-billable time, paid time off, utilization, we want to bake that cost in here. So we want to generally set our project target 10 to 20% higher than our agency target for margin. And that really becomes the floor when we're negotiating discounts with clients. If we're starting to push projects down into the below 60% range in terms of gross margin, we want to start to be concerned. There's a very good chance that that work is not going to add a whole lot to the bottom line if it's getting down into that 50 or 40% delivery margin range. We've talked about margin levers, which are the 3 ways in which we can improve our margin. And that is really the scope of today's presentation. I want to make sure we leave some time for Q&A. And we can also go through scenarios if we'd like. So Ilia, I'll invite you back up if you want to go through some of that stuff.
Thank you, Marcel, very much. We're now happy to open it for questions from the audience. Feel free to post your questions on LinkedIn, and we'll just bring them to the screen. And maybe while we're waiting for the first question to come in, Marcel, for agencies, agency owners, founders who maybe are doing a little bit of understanding their profitability, but they're not exactly happy, and they want to implement something more robust, just as what you just showed there. Mm-hmm. Where would you recommend they start? What is like the first step that you'd suggest they take?
Well, I'm sure you noticed this, but all of these metrics that I talked about require time tracking data. So if you're not tracking time, I do recommend that you start there. And I want to acknowledge, I know we're on a Toggl webinar here, but like nobody wakes up in the morning and says, I just can't wait to sit down with a fresh cup of coffee and fill out my timesheets. Okay. I think we can all agree that it's a universal truth. Time tracking is seen as a chore, not something that we enjoy doing, but I can't stress enough how critical this data is to the health of an organization and how important it is to protect everybody in the business from negative things like being overworked and being overscheduled and so on. You must be tracking time. So if you're not tracking time, start there. I think that's the answer to the question, the simple one. And beyond that, I think the really important thing is to consider the structure of your time tracking data. And so the simple formula for this is really paying attention to, like, if you create an estimate, you should be able to hold up your timesheet and have those things look the same. And where we see this break down is we'll go into a client's time tracking tool and, okay, the client matches up, so I can tell how much time we spent on the client. Maybe the project matches up, so I can tell how much time we spent on the project. That's all great. But then we get into, for example, the roles. So we estimated how many hours it was going to take of design work, but in the time tracking tool, we've just got some random task and we have no idea what role that belonged to. So there's a breakdown of the schema. What we want to do is try to make sure that there is complete alignment between how we think about and estimate work and how we track time. And in doing that, our data will be much more useful for answering these questions. And it'll also be way easier to forecast into the future because we'll have alignment between our project management model and our estimation model. So resource planning, all that stuff gets way easier because we're not having to translate our thinking from one format into another.
Awesome. Thank you very much for that answer. Of course, we're happy to hear that time tracking is critical, and we know it's the gospel we live by as well. But of course, I would be the first to acknowledge that no one wakes up being excited to do time tracking, and that's why it's so critical to explain how it helps and for people to understand how it helps, so they have intrinsic motivation to do it.
Yeah. And on that note, it looks like we're still waiting for, oh no, we got some questions rolling in. Sorry, I'll defer back to you.
Sure. I'll bring the first one from Katie screen.
All right. So if we expect a writer to work 100 hours on client work and 40 hours on internal work, should I break that down into delivery costs and overheads? That is a great question, Katie. So there's kind of two elements here that are separate. And this is something we spend when we do engagements with the clients, consulting engagements. We tend to spend a lot of time on this question of salary allocations for the P&L versus time allocations. So there's some nuance here, but the first question that you want to ask yourself is, that writer, what percentage of their salary belongs to the delivery team versus the admin team? And there's an important question here, which is, in a perfect world where you have unlimited client work to do, I think what we see a lot of people do in cases where their utilization is going up and down or things are not busy is they will give their team internal work to do. And then they start to think, oh, well, I should allocate a certain amount of their salary to that internal team based on the amount of time that they spent. It might seem like allocating salaries based on time actually spent is a more precise way to do things, but it's actually the opposite. If I start taking low utilization and hiding the cost of that in sales and marketing admin because I gave people busy work to do when it wasn't busy, I'm hiding the cost of poor utilization in those departments. I'm not seeing it reflected in delivery margin. So there's one question, which is really a question of what team does this belong to? And this is in terms of a salary allocation. Salary, sorry, I can't spell today. Allocation. And this is on your financials. So if you're saying that, okay, no matter how much client work we have to do, no matter how busy we get, this person's job is designed to spend 40 hours on internal work in a given time period, that is part of their responsibilities, then you might split them accordingly and put part of their salary into admin and overheads and part of their salary into delivery. However, if their actually full-time job is to work on client work, and they just happen to spend 40 hours on this thing because it's a one-time project, or you're just not that busy right now, then you're probably allocating much more, if not 100% of their salary to delivery. And you're seeing the cost of, utilization fluctuations then reflected there. And then there's the second question of delivery hour or utilization targets, which have to do with, how much of their time do we expect to be deployed against client work? So where people start to get confused is they're like, okay, well, this person works 40 hours a week, but their utilization target is only 32. So that means that 8 hours of their time is spent on admin or overheads, which is not necessarily true. Again, we could have a person that 100% of their salary is allocated to delivery. And again, this inefficiency here is just part of, the inefficiency of the delivery department, which is to be expected. They're not going to be working on client stuff, all 40 hours of their week. They're going to fill in their timesheets. They're going to be on internal meetings, etc. That stuff is not necessarily admin or overhead work, but it's still stuff that's non-billable. So there's this difference between those two things. Hopefully that's more clear. This is a very nuanced topic, and a lot of times this is, a 60-minute conversation with a client to work through all of the edge cases, but hopefully that gives you a little bit more clarity, Katie. And I appreciate you showing up here. It's great to see you asking these questions, and I hope everything is going well at Flycat. Thanks for being here. Yeah, and so Katie, in this case, probably it's all delivery costs.
Thank you very much, Katie. I think we have time for one more question. Jitesh is asking, do you also have any benchmarks for how much estimated delivery time to plan for us so as not to overwork the team?
Yeah, this is a great question, Jitesh. And what I would recommend you do is there's actually a resource in the Agency Profitability Toolkit that will help you run these numbers. But basically what you want to do is map out your entire team and put in like what are their weekly delivery hour expectations, so you have some clarity on an individual basis, what does that look like? And then as a team, what can we handle? What seems reasonable? Because of course, as you change levels and start forecasting at different levels, these things are going to start to kind of blend together. So the simple answer is try to utilize them to their utilization target. And for most people, what's reasonable is going to be somewhere between 28 and 32 hours per week. That is typically like a reasonable range where people will be busy, but they're hopefully not going to work over 40 hours on a regular basis. And in cases where you have very low client dilution or very lean internal processes, you might be able to push that to 34 or 36 hours. Very rarely do I see it go above that and still be reasonable. The cases where that becomes possible is like you have a developer, they're working on the same client for 6 weeks straight. And there's barely any internal stand-up meetings. There's barely any administrative responsibilities for them to take care of. They just get to come into work and work for that client nonstop. Then you might put a 34 or 36 hour delivery target. But in a regular context, in a regular agency where they're bouncing around between a couple different clients, they've got to be on team, meetings, they've got some other stuff to do, then probably that 28 to 32 hours a week range is what's a reasonable target. And then forecasting becomes as simple as, simple, but not easy necessarily. Would be as simple as basically running this kind of scenario. So sorry, let me just grab my reference here because I drew this up specifically for this session. But you're using the metrics that we talked about earlier to just look out into the future. So if we wanted to do a utilization forecast, we would first take our revenue in a period. So let's say for next month, we had $100,000 planned in revenue. We would divide that by our ABR. So if we had $100 per hour and we had 100 grand planned for next week, then obviously that's going to be 1,000 hours worth of work. And then we divide that by our capacity. So in this case, if we had 100K divided by $100 per hour, that equals 1,000 hours. And if I have 2,000 hours of capacity, then I'm going to be utilized at 50% next month, right? So that's probably okay. And if we had more revenue, we'd probably be in a good place. If we had less revenue, we'd probably be in a bad place. So you can start to use these things to forecast and get a sense of, is our utilization going to be higher than what we theoretically should be at, or is it going to be lower, and start to make staffing adjustments based on that. Hopefully that helps, Jitesh. Great question.
Really cool. And one more from Megan, who's asking if you can repeat the formula to calculate what ABR is ideal to achieve profit margin. So.
Great question. Okay, so back to the formula for ABR. It's agency gross income divided by hours. So in this example, if we have a project that our agency gross income is $15,000 and we spend 200 hours to get that project done, again, doesn't really matter if those hours were technically billed or not. It took us 200 hours to get the project done. Therefore, our average billable rate is $75. This is an example of two things: the difference between revenue and agency gross income, right? So in this case, the client gave us $30,000 for the funnel build, but maybe we spent 20 grand on ads. So really, we only had $10,000 to work with. We got it done in 50 hours. Our average billable rate was $200. And the way that we would figure out our margin, or start to estimate our margin based on average billable rate, is using the same formula as the formula for delivery margin, but instead of using AGI and delivery cost, we're using the more underlying indices of that, which would be average billable rate and average cost per hour. So here's the formula for that: ABR minus average cost per hour divided by ABR. So in this case, if I have a $150 average billable rate on a service type, and on average I spend $60 per hour to get it done, then my margin estimate is about 60%. Hopefully that is helpful, Megan. Thank you for the question.
Really cool. Marcel, thank you very much for your time. I really learned a lot from your presentation. I hope the people who are listening did so as well. And I really hope this is not the last time we have you as a guest on the Toggl Academy. I think there's a lot more that you can share with us, and I'm sure people will be really eager to hear it. For everyone who attended, thank you very much for joining us. This is definitely not the last such event that we plan, and hopefully we'll have news for you very soon about our next guest, so you can join us next time.
Thanks so much, everyone, and thanks for having me.